Hi, maybe you have heard the term creative accounting. In the past, there were no rules for making provisions, and as a result, provisions belong to the most frequently used creative accounting practice. While companies were involved in so-called big bath provisioning, which effectively means creating and reversing provisions back and forth from period to period in order to smooth profit. To prevent these practices, the rules related to the reporting of provisions, contingent liabilities, and contingent assets were created in the standard IAS 37, and we will take a closer look at this standard in today's video. I'm Sylvia of IFRSbox.com, and I help people understand and simplify IFRS. I have created the IFRS Kit, a complex IFRS course for you, plus lots of free IFRS materials, so you are welcome to check them out at IFRSbox.com. The standard IAS 37 belongs to older standards as it was issued in its current version in 1998 with the effective date of 1st July 1999. The objective of IAS 37 is to set the criteria and rules for measurement and recognition of provisions, contingent liabilities, and contingent assets, plus set the disclosures required for these items. So what is a provision? It is a liability of uncertain timing and amount. Now, let's concentrate on the first part of the definition. What is the liability? A liability is a present obligation of an entity arising from past events, the settlement of which is expected to result in an outflow of economic benefits of an entity. The critical point here is occurrence of past event or obligating event that gives rise to an obligation. Well, if there's no past event, then there's no obligation and there is no liability. Past event might create two types of obligations. The first one is a legal obligation that derives from some contract, legislation, or some other operation of law, for example, a court's decision. The second one is constructive obligation that derives from some entity's actions, such as from established practices or some statement of acceptance of some responsibilities. Well, in fact, there is no difference between provisions created by legal or constructive obligations with regard to accounting treatment. However, if you identify the underlying obligation, whether it's legal or constructive, that may help you to identify when to recognize a provision. So, when should we account for a provision? Well, if all three following conditions are met. Number one, there must be a present obligation, whether legal or constructive, as a result of some past event or obligating event. Number two, the outflow of economic benefits required to settle the obligation must be probable. Well, this is the higher probability of having to pay than not having to pay. In numerical expressions, more than 50%. When probability is less than 50%, in other words, it means that the outflow is just possible, and then the company would probably disclose just the contingent liability or even nothing if probability of outflow is remote. Number three, there must be reliable estimate of outflow of economic benefits that is required to settle the obligation. In extremely rare cases, when no reliable estimate can be made, liability exists, but it cannot be recognized. So when deciding on recognition of provision, we must assess all three conditions. If they are all met, then the provision is recognized, or if not, just not meeting one condition is sufficient, then entity just discloses contingent liability or even nothing if probability of outflow of benefits is remote. Well, here, in order to decide whether to recognize a provision or to disclose a contingent liability or even do nothing, IAS 37 gives us a decision tree, and if you're interested, you can also check that out in our complex course, the IFRS Kit, together with numerical examples. If you find yourself in a situation when you're questioning whether to book a provision or not, well, you should ask yourself one simple question and the answer will guide you. Can you avoid the obligation by some future actions? If yes, then do not recognize any provision because it means that there is no past obligating event. For example, well, when a government is introducing new laws and your company must train the employees to stay updated, Well, your company may still decide not to continue in business or not to train the personnel and thus avoid the expenses. But if you really cannot avoid expenses by any future action, then you must make a provision. For example, if you promise warranty repairs when selling some product to your customers, then you must make a provision for expected costs associated with warranty repairs. Let me explain contingencies to you now. Company may face both contingent liabilities and contingent assets. Well, a contingent liability is either possible obligation that arises from past events and its existence will be confirmed by some uncertain future events that are not wholly or fully under company's control. Alternatively, it is also a present obligation that arises from past events, but outflow of economic benefits is just possible, so less than 50% probable, or the amount cannot be measured reliably. Well, a contingent asset is something similar. It is possible asset that arises from past events and whose existence will be confirmed later by occurrence or non-occurrence of some future events out of entity's control. For example, when you are suing somebody else and expect winning the court case with some compensation from other party. In such a case, result of court proceedings is out of your control and this possible compensation would represent contingent asset. Neither contingent liabilities nor contingent assets shall be recognized in financial statements. That means no accounting, okay? But you must disclose their existence, their nature, estimation of financial effects, indication of uncertainties, and some possibility of any reimbursement, and disclosures must be made in the notes to the financial statements. Well, how shall we measure the provisions? Provision should be measured as the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. And this estimate of outcome and financial effect are determined by the judgment of the management of an entity, supplemented by experience of similar transactions, sometimes reports of independent experts. And you should also consider any available evidence. There are two most often ways of measuring provisions. The first one is so-called expected value, and it is used when measurement of provision involves a large population of items. Then the provision is measured as a weighted average of all possible outcomes by their probabilities. The second method is used when a single obligation is being measured, and then the provision would be set as the most likely outcome. When measuring provisions, there are several considerations that you must look at. Risks and uncertainties that surround many events and circumstances, for example, inflation. Also, when you expect to settle your obligation beyond 12 months after the end of the reporting period, then the amount of provision shall be the present value of the expenditure required, and there is some discounting involved. Amount of provision might also include certain adjustments for future events when there is sufficient evidence that these will occur, but be careful. When measuring provisions, gains from expected disposals of assets shall not be taken into account. These gains are included in the income statement at the time specified by another IAS or IFRS standard, for example, IAS 16. How to account for a provision? Well, a provision is recognized as an expense in the income statement in most cases, but sometimes it can be capitalized into the cost of another asset, okay? The credit side goes to a liability, but careful in the current or non-current distinction. Well, when the amount of provision represents its present value due to some discounting, then you would charge an interest on a provision each reporting period to bring it to its future value by the time of its utilization. This is called unwinding the discount, and in this case you debit finance costs in profit or loss, and on the credit side you should increase the amount of a liability. Well, provision is utilized when an entity is obliged to settle in most cases, and unsimplified accounting would be just account for the related expenditure by direct debit into provision and credited the cash, suppliers, bank accounts, whatever form the expenditure has. Alternatively, you can treat the expenditure by its usual way, posting it to profit or loss, for example, and subsequently reverse proportionate part of a provision. That's what many entities do, in fact. When you expect some reimbursement from another party, you can recognize reimbursement asset when it is virtually certain that it will be received, but careful, in the statement of financial position or balance sheet, reimbursement must be shown as a separate asset. So your journal entry would be to debit reimbursement asset, which is some sort of a receivable, and credit expense for provision creation in the profit or loss. Well, it is not credited to some sort of income because IAS 37 permits to present expense related to provision and its reimbursement as a net amount. There are certain specific situations directly addressed by IAS 37 in relation to provisions. The first one is future operating losses. Future operating losses, they just don't meet the definition of a liability because there is no past event, okay? And moreover, you can avoid future operating losses by implementing some measures to prevent them, or by selling a part of operations making a loss, or some other actions. Therefore, you should not create a provision for future operating losses, but when you expect future operating loss, that might mean that your assets are impaired. So you should test your assets for impairment and recognize impairment loss under IAS 36. And you can find a summary of IAS 36 in this channel too. Another specific area addressed by the standard relates to onerous contracts. So what it is unfair contract in which the unavoidable costs of meeting the obligations of the contract exceed the economic benefits of the contract. In other words, this is a loss contract that cannot be avoided. If a company identifies that a certain contract is onerous, provision must be made in amount of unavoidable costs of fulfilling it. And unavoidable costs can be either net cost of fulfilling the contract, that means cost less some income from the contract, or penalty from non-fulfilling the contract, whichever is lower. Of course, you would also look to any impairment test. The third specific situation addressed by IAS 37 is restructuring. Well, this is the program that is planned and controlled by the management, and it materially changes either the scope of the business or the manner in which that business is conducted. Well, in general, a provision for restructuring must be recognized when two conditions are met. First, a company must have a detailed formal plan that contains the minimum information about the related business, location, employees, expenditures, and sometimes schedule. Also, a valid expectation must have been raised by the company in those affected by the restructuring that the company will carry out the restructuring. And then IAS 37 specify what components or types of expenditures can and cannot form part of a provision. Finally, let me also name a few interpretations that deal with some specific cases of provisions. So first, IFRIC 1, changes in existing decommissioning, restoration, and similar liabilities, deals with the provision for removing the asset and restoring the site after the end of its useful life. And this is very important, for example, in nuclear power plants that are obliged to remove nuclear plants at the end of their useful life. Well, if you'd like to revise the full solved Excel example about this type of provisions, you're welcome to check our IFRS kit. IFRIC 5 writes to entries arising from decommissioning, restoration, and environmental rehabilitation funds is closely related to the first IFRIC, number 1, and it applies when a company contributes to a fund for reimbursement of these expenses. IFRIC 6, liabilities arising from participating in a specific market, waste, electrical, and electronic equipment. Well, this IFRIC specifies when the producers of electrical and similar appliances sold to households are liable for decommissioning of electrical waste. And this applies mainly in the European Union, which obliges all producers to do so. Also, IAS 37 refers to two other interpretations, which is IFRIC 17, distribution of non-cash assets to owners, and IFRIC 21, levies. So this was a short summary of IAS 37. You can find the full and detailed explanations with many numerical examples in our IFRS kit. And if you'd like to learn more about IFRS and its application, you are welcome to check our website ifrsbox.com and subscribe. Bye bye, and thank you for watching.